All right, class. So we're going to jump right in to Module 4. First, we're going to talk about the history of the capital markets. You'll be able to see a comparison. Then we're going to talk about diversification and portfolio risk. We're then going to talk about how we calculate that portfolio risk. And then we're going to talk about how individual securities affect that portfolio risk. And then we're going to talk about the diversification itself, and then this value additivity. We'll get into what that means. We're then going to talk about Markowitz and sort of like the birth of portfolio theory. We're going to talk about risk and return. We're going to talk about the capital asset pricing model, which you'll hear called the CAPM. And then we're going to talk about some alternative theories, which they'll be similar to this capital asset pricing model, but normally it's additional factors. So let's jump right into about how capital markets have performed over the last century. If you had $1 at the end of 1899 and you invested it, how would it have grown by the end of 2017? You notice the red line is for the T-bills, the blue line is for bonds, and then the green line there is equities. Although we do know that the value of the dollar has changed, so this is the investment itself, but what about in real terms? Well, in real terms, you see a $1 in the equities market would have grown to about 1,700, and this is after accounting for inflation. So over time, equities, perform very well. You notice bonds don't perform as well, but they do perform better than the bills. And hopefully, you can start to see a relationship between risk and reward, although we'll address it more explicitly later on in this module. And this is just to give you a sense of the market risk premium. This is the nominal returns minus the nominal returns on T-bills, where T-bills would be the risk-free, right? So just to give you a sense of like the market risk premium over this time, but understand that it's changed. So it's not static over that 100-year period. This will show you dividend yield. If you notice, dividends swung a bit and then they dropped and held fairly steady from 1950s up to the mid 1970s. Then you notice they went higher through the 80s and then dropped again. What you're seeing is mostly an artifact of tax policy, right? So as dividends get treated differently, capital gains get treated differently. You start seeing the firms respond differently. There's a very well-known theorem that we have that shows individuals are indifferent between like dividends versus retained earnings and the stock appreciation that way, but for taxes, right? So taxes are what drive some changes there. This is just to show you returns. So stock markets obviously have a lot more ups and downs, right? And you're seeing that here. Where bond returns would not look nearly so erratic, and the government returns, obviously those are guaranteed. So, and this is a histogram of returns, so you can kind of get a sense for what they look like. There are returns that are extremely negative. There are returns that are highly positive. You notice it's skewed slightly positive because we are growing over time. But the number of years with very low returns, though, is significant as well. Okay, so that being said, now we've sort of addressed the history of these markets and the relationship there. Let's talk about diversification and risk. And the first thing we have to do is come up with a definition of risk. So what we're going to use for our risk measure is how much variance about the mean there is for your returns. So how volatile is your return? And so variance is the squared deviation, right, from the expected return. And I'll show you how we calculate that. But we're going to take that, how far an expected or a number is from the expected value, which is the mean. So how different is that from the mean? And then we square that, right? And then we'll sum those up. If we take the square root of that, we then get the standard deviation, We prefer to talk in standard deviations because it's the same units, right? Because the other one is squared. So we take the square root and we get back to the same unit. So we could talk about dollars plus or minus another set of dollars, right? So, and this is just to show an example. This is 3 different rates of return. You can either gain 40, gain 10, or lose 20, right? And then when you're looking at how far that is from the mean, the average return, right, would be 10, right? Because it's 10 plus or minus 30, right? And so how far is it? You see the plus 30, the minus 30, you square those, you get the 900, 0, 900, multiply it by the probability. So 25% chance you gain 30, 25% chance you lose 30, and a 50% chance nothing changes. You multiply those together, and that gives you the variance. You take the square root of that variance, and that gives you the standard deviation. And then this is a measure of that standard deviation. So just understand that as we're talking about this, it's not a static thing. These deviations change over time, but it's just a way for us to talk about this relationship between risk and return. And first, we need to come up with a definition of risk. So what is diversification, right? It's when you have a number of investments, and then we're going to use those investments to reduce the risk of the portfolio overall. Specific risk, they say also diversifiable risk. I've also heard idiosyncratic risk. Those are risks specific to your firm because of your operations, right? Market risk is different because these are the things that affect everyone in the market, right? Or systemic risk, everybody that's within this system, right? So I can use the market to get rid of the specific risk of a firm, but I cannot eliminate market risk. And what that means is there is always going to be some risk that I'm not going to be able to get rid of, but I can get rid of the risk that I would have from just having one or a few firms. And here's an example of building a portfolio. If I start with one firm, my standard deviation is much higher. And as I add additional firms, it begins dropping, but it slows down as it's dropping. And that's because there's a certain level of risk that I simply cannot use the market to get rid of. So I can use the market to get rid of the risk specific to firms. I cannot use them to get rid of the risk that's associated with the market as a whole. When we're talking about variance between two stocks, you'll find that we have to use this, what we call variance covariance matrix. And to show sort of what these blocks mean, stock one and stock one, the upper left-hand corner, right? What we're looking at is what is the change in stock one as stock one is changing, and that's the variance. Just how much noise is there in that variance, right? And so you see the sigma squared, that's our symbol for variance. And then down here, you notice this is sigma squared, but it's for stock two, because again, this is the variance of stock two. So the upper left-hand corner is stock one's variance, lower right-hand corner is stock two's variance. These cross variances here are what we call the covariances. That's what makes this a variance covariance matrix. And these numbers are the same. Okay. And so what it is a measure of is the standard deviation of each of those. And we're going to multiply that by the correlation. That's what that rho 1, 2, it looks like a P, but it's a lowercase rho. And that's a measure of how related they are, right? That correlation. So correlation of -1 is perfectly negative correlated. One goes up, the other goes down. They perfectly offset. And a correlation of 1 is they perfectly move together. And so everything falls between -1 and 1. And then based on that, that will give us this covariance piece. And here's an example. 60% is going to go into Southwest. The other 40% are going to go into Amazon. You're going to expect to get 15% in Southwest and expect to get 10% in Amazon. You would just take those weights and multiply them by those respective returns, add them together, and that gives you your expected return. Okay, so I have an expected return, and then I'm going to have what my actual return will end up being. Okay. So the standard deviation of returns is 26.6% for Amazon and 27.9% for Southwest Airlines, right? So standard deviation of Amazon, standard deviation of Southwest, and I'm going to have to square those to get variance, right? And then this first piece is the weight, and I'm squaring those weights also. And then for the, assume a correlation coefficient of 1. So remember that correlation coefficient goes from -1 to 1. In this one, we're going to use 1. And so you just multiply the weights times the standard deviations times that correlation, and that gives you the variance covariance matrix. Okay, so now that we have that, okay, we have, again, our same investment. Everything is staying the same. What is the portfolio variance, right? We just add those 4 boxes together. So this is Southwest Airlines. The 40% one is the Amazon. And then you notice it's 2 times a product. That's because those 2 boxes are identical, right? So it would just be 2 times that. And that would give us our standard deviation. We take the square root of the standard deviation, and that gives us, square root of the variance, and that gives us the standard deviation. So square root of variance is standard deviation, right? So now they're going to change it, and they're saying, okay, well, what if the correlation isn't 1 and is instead 0.26, right? And if we were to do that, you notice the standard deviation falls. It was at 27%, and now it's fallen down to 22. If the correlation went all the way to -1, you notice the standard deviation then falls all the way to 6.1%. Right. So the key takeaway is the less correlation there is, right, then the more diversification benefit you get, the safer your investments end up being because of this portfolio, right? And this is our expectations for our portfolio. We're going to try to make things safer. That's why we're adding additional investments. So the 2 equations that we're going to focus on, expected return and then the variance. The expected return is the weight times the return of one plus the weight times the return of the other one, right? And then by combining those, that gives you the expected return for your portfolio as a whole. And for the variance, this is just that variance covariance matrix. So the weight squared of 1 times its variance, the weight squared of 2 times its variance, plus 2 times that covariance piece. And so this is an example. They have a correlation coefficient of 0.4. They give you the sigma, they give you the weight, and they give you the average return, right? And so we just put those into our portfolio, and then we can calculate what our return is and what our standard deviation will be. Okay. Now, what if we have this and we want to add another stock to the portfolio, right? We would just continue to add these things in, right? And because we're adding more and more of these not perfectly correlated stocks, we're getting that diversification benefit. Another way we can talk about risk is by beta. If you were to have a market portfolio, that would be a portfolio that is perfect of the market, right? So it represents all markets appropriately weighted. We'll often use things like the S&P composite, okay? And then we can compare our own return to that market portfolio return, and that would give us our beta, right? Which is how sensitive we are to market changes. So this is an example looking at Amazon, right? So if the return changes at 1.47% for every 1% change in the market, the beta would be 1.47. It's the slope of this line, okay? And this is what we're going to use most of the time when we're talking about these types of risk, is we're going to talk about it in terms of beta. And this is just to show you this relationship, with beta and the portfolio risk. So when we're going to calculate this, right, we're going to take the covariance between the stock market and the market returns, and then divide that by the covariance of the market. That's what gives us beta. So if it is the same as the market, so the covariance between the market returns and the stock returns were the same as the variance of the market, you get a beta of 1, right? And that's the same as the market. Anything greater than 1 is riskier or has more sensitivity, and anything less than 1 would be safer or less sensitivity. And this is just example showing how we would calculate that type of beta. Okay, so Harry Markowitz is the guy that came up with this portfolio theory, right? So we're going to combine stocks into these portfolios, right? And as long as we're not perfectly correlated with each other, which we tend to not ever be with anything, so there is some benefit from it, right? And what we're going to do is create what's known as efficient portfolios, so that people, investors, regardless of their short-term or long-term desires, would choose one of these efficient portfolios for their best possible return for the level of risk. Okay. And this is to show that over large data sets, things start to become a bit more normal. It's a central limit theorem. And so we're going to talk about a lot of our investments in terms of what the average value is. So the peak sort of this normal curve there. Okay. And then we're going to talk about how wide that is, right? So it's the standard deviation and the mean, right? The expected return and the standard deviation. This shows one investment, right, with a particular mean, and then you see the expected returns and how wide those are. And then here's another one, identical mean, but you see a lower standard deviation. The figures are much tighter in around it. And this one has a higher mean, right? So these are the types of comparisons that we're making between them. What's the mean and what is the standard deviation? And that's how we're going to end up graphing these, right? So in our particular case, we had Southwest Airlines and we had Amazon, 60% in Southwest, 40% in Amazon. They gave us the standard deviation and the expected return for each. And then we built a portfolio. And if you notice, it's that blue line. Now, if our correlation between them had been 1, our line would have been that yellow dashed line, right? We would have been somewhere along that line, which means we're not getting a diversification benefit. And then if you look at the red line where it gets pulled all the way, that blue line will basically start stretching. That curve gets towards that red point, and then when it gets there, it actually sort of snaps. And that's if the correlation is -1. So that's the best possible portfolio we can build. is a row of -1. This is an example saying, look, if we just went, grabbed 10 stocks and then built this efficient portfolio, what would this look like? And you see the portfolio returns and the expected standard deviation of the portfolios. And this is what we're trying to come up with, is what is the highest possible return we can get for a particular standard deviation, right? And this is what we're talking about with that efficient portfolio. It would be something along that red line, right? This is known as the efficient frontier, right? Because it's the very border, it's the very edge of where you can get to and invest, right? Those are the portfolios available. Now, we can do a little bit more if we can borrow and lend. So this shows you an example of borrowing and lending. So if I want to get safer returns, I would have lower standard deviation and a lower return, I can lend, which is what you do when you buy government bonds. You're lending the government money, right? And so by doing that, you get this safer side of the investment. Borrowing would be borrowing money to invest. So this is like margin loans, and I borrow money to put more in the market. And so I'm allowed to then go up along that borrowing line, which actually gives me a higher return than is possible using the frontier, right? And so that's a way to sort of get a bit of around that, as long as you can borrow and lend at that risk-free rate. It gives you that option. And this is just to show an example. You have two different investments. They're not strongly correlated, only 0.19. They give you two weights. You can do this as an exercise and calculate those standard deviation of the portfolio, and then what the average or the expected return of the portfolio is. And again, we can't just add standard deviations together to get that. We have to take into consideration that correlation. So we got to calculate the variance. And then once we have that, you notice that the real standard deviation is 28.1%. So it's because that diversification benefit, right? That additive form was assuming was just wrong. So that don't do that, I guess, is the answer. Right. And so again, how do you get higher return and lower risk? Right. Because if you notice, by that diversification, by having that show up, it gives us a safer return for this. Either we can be safer or we can have a higher return, but we're maximizing either way, right? So it doesn't matter if you're risk averse or if you're seeking gains. Either person wants to build these diverse portfolios. It says the goal is to move up and left. If you're moving up, you're getting higher returns. If you move left, you're getting safer returns. So if I can get safer returns, but it's still more money, that's what I want, right? And so what we do to evaluate if we're doing that appropriately is the Sharpe ratio. So we look at our returns, and then we subtract off that risk-free portion because we know we're really just being paid for the riskiness. And then we divide that by our standard deviation. And that Sharpe ratio, it's not something with like a trigger if this number is above this or below that. It's really more looking at it over time, as a comparison to see, are you getting what's appropriate versus other investments you could be making. Okay. And so we're going to talk about this relationship between risk and return. For this measure of risk, they're saying beta. Okay, so just think in terms of beta, where beta of 1 is equal to the market, right? Any beta that's greater than 1 is more sensitive than the market, and a beta less than 1 is less sensitive, right? So if you start with the risk-free rate, which you get with your T-bills, and then you look at where the market return is, right? And that gives you where beta of 1 is. You connect those 2 points and you get the security market line. And so I can think of any firm and I can calculate their beta and say they should fall along the security market line. And they may fall above the line or below the line, but that measure above and below the line is what we call alpha. So if you ever hear about people seeking alpha or trying to gain alpha, that's what they're talking about, is they want returns greater than what would be expected just from the level of risk that they've assumed, right? And so if you think about what we have, you have this difference, right, between the return on the market and the risk-free, right? And then we're going to multiply that by this beta over here, and that will tell us what our return should have been, but we have to subtract the risk-free from that as well, right? But that's how we can calculate what that will be, and that's this capital asset pricing model, right? So you'll see this written sometimes as the required return on an investment is equal to the risk-free plus beta times that market risk premium. It means the same thing algebraically, right? So you can see a beta of 1 will give you a market return, a beta of 0, you expect this risk-free rate, and then that gives you the security market line. And then we can go and look at stocks and see what the betas are and see what the expected returns are. And then we can see what does that look like in real life when we start plotting these. Are they above the line, below the line? And this is an example, right? So what if they are down there below it, right? What would happen? Well, if you were in stock A, you would want to move right more into that market portfolio. You're trying to get back to the security market line, right? And so by doing that, we're going to put pressure upon those prices and move things into equilibrium. Okay. But this is to show, like, if you look at it over time, how well is this beta done? So we would expect it to be on the line, right? But you see how from the larger period over this, right? Beta has not been nearly as sensitive. However, if you look at when most of these things were written, right? And so this is the 1960s, and it fits the line much better. So it probably makes sense that people using data of that time started talking about beta and things a lot more because it was a much more effective predictor, right? And then if you look at since that time period, we're starting to look more sort of like that historical, where there's probably some things that aren't explained just by beta, right? So it does have explanatory value, but it's not explaining nearly as much as it did in the 1960s, right? So one of the things that we can talk about are adding additional factors, right? And so what would those additional factors be other than just the market? One thing would be looking at book value, right? So if I look at companies that have high book values and companies that have low book values, right, I can get a sense of that. And then you see where it says small minus big. I can do small cap firms and large cap firms, because I know small cap firms tend to have higher returns. Large cap firms tend to have lower returns, everything else being equal, right? So by comparing those, right, I could introduce additional factors and it not just be the market, which is what CAPM is. CAPM just looks at the return of the market and gives you a beta. So in this case, we could have multiple factors, right? And we would write our risk as being each of those factors having its own weight, and then some alpha term, and then some noise, right? And so then once we calculate what those would be, then we could calculate what our expected risk premium would be from that. Okay, and this is examples of different, risk premiums, for various risk factors. You're exposing yourself to different things depending on how you go into these markets, and that just shows that different factors would have different premiums over this time period, right? So this arbitrage pricing theory is another alternative. We also have this is a 3-factor model here, and so say, okay, let's identify what the factors are. And then let's calculate what the risk premium would be, and then let's calculate the sensitivity. And this is just some examples using sectors, right, to make some comparison. And if you notice, they have a B for the market, or like a beta for the market, and then like a beta for size. That's the small minus big, right, returns, and then the book to market, the high minus low book to market. And then you see the expected return of those and the expected return of CAPM. And sometimes that can be a better explanatory for it. So, all right, well, that'll conclude Module 4. Thank you so much.